Today I want to break down a very simple approach, right? We use this approach every single day on the market, right? The day we're going to be talking about is 8/23/2024, right? Jerome Powell was on the mic. Price action was extremely volatile, right? And me and most of the team were ready to not even trade, right? We don't like to put ourselves in vulnerable scenarios where our edge doesn't apply. But that doesn't mean we walk away from the computer, right? That means we watch patiently and we wait for our edge to show up, and if and when it does, we act, right? So I want to break down this very simple approach using, once again, the critical pit numbers, right? So to really break this trade down, I'm going to run you through the A through Z process, right? So basically, this is what the market looked like in pre-market, right? We had this range that we were trading in, right? And you can see the blue lines are my pit numbers, right? Previous day high, previous day low lined up with bullish structure, right? Which you can see was a beautiful retest on this much larger time frame, right? So I always have to check out the larger time frames to get a understanding of market context. Market context is just a pretty word for market structure. Is it bullish or bearish, right? Like, that's what I want you guys to think about anytime you hear somebody say market context, right? I need to see on a larger time frame who's in control of the market, and all what that means is what sort of chart pattern am I looking at on a larger time frame, right? And when I say chart pattern, I'm referring to the break and retest, right? Obviously, there's other ones, but I like to view the market in a structural fashion. The structure, that's the break and retest, right? So you can see we get this bullish break, and now we retested 55550, and you know, things are relatively bullish, right? So this is what it looks like pre-market. Now I'm going to drop down to the 5-minute time frame, right? So you can see we were getting a significant gap up, right? This is end of day, right? Well, wait, before I go further, these yellow lines right here. What are these yellow lines, right? So these yellow lines are what I call daily critical levels, and all what they are previous pit numbers, right? This means it's not previous day high, this is previous day high, right? Because once you start to learn, right, how to read candles, it's very effective to learn to read the candles on a larger time frame, meaning daily time frame, right? Everything that applies on that 5-minute time frame applies on a daily time frame as well. So as an intraday day trader, this can be very beneficial, right? So if I see strength at previous day high, that's very bullish. If I see strength at previous day low, that's very bearish. And if we're trading in between them, that's just as beneficial to me, right? You guys got to look at it like this. We stare at market information all day, right? So you have to ask yourself, what type of information is valuable to you? And the answer to that is the type of information that's going to help you make money, right? Now, to make money in this game, you need to understand the momentum of the market. So if I watch what happens at these levels, I will then have a better understanding of who's in control of the market, right? So let's just highlight these and see how they played a role. Okay. So market opens up, you can see we start to rally, right? We're getting, where are we at? Hold on. This is 2-minute time frame. Market shows up, and you know, we're getting this battle at open print. We really didn't want to put on a trade because there was news dropping at 10 a.m. Eastern, right? That's when Jerome was getting on the mic. He was going to talk about the state of the economy, how he felt about it, right? It was going to add a lot of volume to the market, right? And me personally, I don't like to put myself in vulnerable scenarios where my edge no longer applies, right? So if I see a chart pattern at 9:59 a.m., you know, that's supposed to be bearish, and Jerome Powell gets on the mic and stubs his toe and the market rips, right? That is putting me in a vulnerable scenario, right? My edge is no longer doing what it's statistically supposed to do, right? So I don't like to trade right before news. And there really wasn't any setup anyways. I mean, look at the market. It was very choppy around open print. There wasn't much direction, right? So not a good place for me to put risk, so no trade. Then the market rallies. Boom. I mean, 2-minute candle. What is the range on this candle? Literally $2 range in 2 minutes. This thing was rifling. And then just notice how the moving averages are holding, right? So we're live on Discord. We're watching this. And we're being extremely patient. And this is why I was so proud of the way me and Darren traded yesterday, because the amount of patience it took to watch price action do this and just not put on a trade. And this is the thing, and I talk to my clients about it all the time. Once you figure out what works, certain things no longer make sense, right? Like FOMO doesn't work, right? Look at the data, look at your journal, look at your past. Are your results working, right? Are those the results you want? And if they're not, you have to ask yourself, what behaviors are you implementing that are giving you those results, right? So we're not going to chase. We're going to stay patient. And then, but I want you guys to notice, look how price rips up the previous day high and rejects, right? We got a pretty large seller there. Then we start to battle at 562, right? So this was very significant to us, right? And look at, you notice we're not getting, we can't make a higher high, right? This is telling me that the seller right here is pretty aggressive, right? Because buyers literally couldn't push price above it, right? It's very important to see that, right? How do we see that? Look at the candle, right? Ask yourself, how is the candle closing at this critical level, right? That's closing pretty bearish. So in my mind, I'm going, okay, if buyers fail here at 562.14, we got a pretty significant move down here to open print. Once again, playing critical level to critical level. And bring it back to that yellow line right there. That's the daily previous day high, right? So if buyers can't hold this level, it's definitely going to play a massive role in me shorting the market down to open print. If buyers can't hold here, there's a very high chance that we're going to revisit open print. We're going to revisit 558, right? Once again, playing the market in balance. This is where all the volume is. There's tons of liquidity up here, down here, and down here. So if price can't hold up here, it only makes sense to play down to open print, to play down to 558. That's how the auction works, right? There's massive pockets of liquidity. These pockets are located at critical levels. Everything in between is just retail traders getting eaten up, chewed up, and just orders getting filled, and that's what we call liquidity, right? So that's the space between. That's going to be your entry, and the market imbalance is your target. That's what's going through my mind. If we can't hold this, I'm targeting this, right? So price then falls down and comes up into this little zone here, and I want to show you guys how I identify these. Right, so on the 2-minute time frame, when we drop below the critical level, we get a green candle. Right, this green candle is my guideline. Right, notice this is what I call a GBI. This is a green bar ignored. Right, when this candle is created, I want you guys to draw a rectangle around it, just like that. Right, a lot of people call them fair value gaps. Right, I don't care what you call them; they serve the same purpose. And they serve you, because when you can start to identify these, you will have perfect entries. Right, because look at now I have to. So the way this works is these buyers are trapped. Right, they showed up to the market, and then they were completely ignored. Right. This is how I identify my risk as well. I will not get in a trade unless this fair value gap's there or this green bar ignored is there, because I need a place to put my risk, and I need a place to watch price reject so I can enter the market down to open print, because I can't just enter here because who knows, I could get in down here at 56148. Price could still go all the way back up to 56214. So I need to manage risk properly. Just because I understand the context doesn't mean I can just enter the trade, right? Managing risk is critical. We do that with green bar ignored on the 2-minute, right? So price then falls down, rips up into our box, right? So when price looks like this, I am now entering the market, right? If this green candle closed above this previous high, I'm not getting in the market. Right? There's a very big difference there. It's very simple, but you have to understand that principle, right? As long as we do not close above the green bar ignored, we enter the market short, and our stop is above 56214, right? So that's where we first entered the market, and then price literally rallied all the way down to open print, which was our first target, and that's where we took profits. right? Phenomenal trade, right? And then I want to show you guys one more, right? So then price rips down to open print, right? It's a great trade. We exit our position. And then price rallies back up into our critical level, right? So notice here. Look at how price is rejecting 562.14. Rip into it, reject. How do we know it's rejecting? How do we know sellers are strong? Look at how the candle cannot close above this level, right? Literally trying. 3 times it tried. It could not close above 562.14. That's how you notice, right? Because the candle is your best friend. You being able to understand who's in control of this critical level is your main way to becoming successful in this market, right? Because once again, we're up here at a level of interest. There's sellers that are in control, and if sellers control this level, we're targeting this level, right? That's literally how it works, playing the market in balance, right? Imbalance to imbalance. So we drop below 562 once again, right? So now the way I'm doing this is I'm going, okay, if I can get any sort of pullback here, I'm going to look for a short play, once again targeting open print. But I need the drop and I need the retest of market structure, right? So once price comes into market structure, I'm looking for this green bar, once again, to be ignored, right? So price rallies up into this purple line, market structure, and I get a very nice rejection candle right here. And once I blow the bottom of this candle, I'm in the market short, and my stop, once again, is above 561.18, right? So I'm risking 38 cents here to make a potential $3 move. Great risk reward. That's how you want to do it, guys, right? So you can see price rips down right back into demand, where we rip back all the way down into previous day low, right? And that's the trade we got right here. You guys can see it was for this. Hold on. What was it? Okay, 67%, right? So once again, price drops below, comes up, tags that cloud, tags the moving averages, right? And that's where we enter the market short there. Price rips down into our first target where we scale 60% of the position, and then price rips into the lows where we exit the full position for 67%, right? So guys, I hope this lesson serves you, right? More importantly, once you start to understand what works, all the other stuff stops making sense, right? So really understanding a good approach, an effective approach that you can manage risk is going to serve you through your journey to becoming a successful day trader. I'm Joshua Salvetti. Hope you guys like this lesson. Make sure you hit a like, join the team, and I'll see you in the next one.